Welcome to another Headway World webinar. Today we are speaking to Nathaniel Lee, who's the Managing Director of Business Protected. And my name's Thomas Parsons. I'm a financial planner at Headway Wealth. Business Protected is a company that provides services to small and medium companies all over the country. And Nathaniel's here to tell us a little bit about what they do and why we are linking up with them to provide a bit of a service to our clients as well. Nathaniel, do you want to maybe give a little bit more of a background on your situation, what you do, and Business Protected to start with?
Of course. Thanks, Tom. Yeah, so I'm Nathaniel from Business Protected. We are an SME brokerage, so we look after the risks that most businesses don't have time to consider. They're not obliged to look after them, like a PI insurance or fleet or cyber or things like that. So it's much more about the people within companies from lots of different perspectives. It could be, there's some that are very advantageous with tax, and others that are about the continuity and the succession of the business. So there's loads of different avenues where companies might need to take advice on these risks that they've got inherent within their business and potentially their personal lives as well.
Okay, so why don't we get straight into talking a little bit more specific around what type of business protection you guys offer and why is it so important for your clients?
Yeah, of course. So I think broadly speaking, there are underlying products, then there's how to write them, and then there's the objectives that they solve. So really, if we start with the objectives, there's four. It's succession planning, continuity planning, employee benefits, and then tax advantages with some of the products. So it's really important for a lot of these businesses to take advice, because there's not that many individuals who work in our space. There's lots who deal with personal life insurance and income protection and things like that, and then there's the big boys who deal with the corporate schemes. But there's a bit of a gap for advice for any SME up to usually under 100, I would say, 100 members of staff. That there's just a gap that they aren't getting that sort of advice. Specifically, it's things like shareholder protection, key person cover, personal guarantee insurance, relevant life, group schemes such as death in service or private medical. Yeah, so that's the broad spectrum of what we do.
Sure. Yeah. I mean, if I just relate it to our job, I'm a financial advisor. I see SMEs, directors of small limited companies a lot, and all financial advisors are qualified to give advice on insurances. But again, it's not our niche, and there's a lot to it, especially when it comes to sort of protecting the business and the shareholders in the right way. So that's kind of why sometimes it's good just to outsource things to a specialist like yourselves that literally deal with this day in, day out when it's the right thing to do.
Yeah, exactly. I think with what you do, there's loads of different things that you need to speak to clients about, and it's the same with us. So if you're talking about potentially 9 or 10 product lines that we do, that there are clients that just need a bit of life cover, or they just need a bit of private medical, whatever it is. But if you're looking at a business that's maybe they've got holdco, they've got trading business, they've got a side business that's an SPV because they're sort of getting money over to invest in property, they've got a load of staff, now they've got an inheritance tax issue, and they've never really protected themselves properly before. If I was a financial advisor like you are, I wouldn't have the chance to do it justice, because there's so many things, and everyone's got their runway of attention, haven't they? People watching this might have already lost theirs. Usually after a period of time, someone's going to switch off. So if you're talking about all of those things, then pensions, then investments, tax plan, all that, it's way too much for most people to deal with in one sitting, I'd say.
Sure. So why don't you give me a bit more and the viewers a bit more understanding of what the four so I think there's four main types of
Yeah.
insurances that you offer and why they're important for and kind of where they're relevant as well at each level.
Yeah, cool. So the easiest way I can explain it is it's built on insurance that most people will be somewhat familiar with, and then it's how do you write those policies to achieve certain objectives. So on the baseline, you're looking at life insurance, obviously very black and white. You're either dead or you're not, so it pays out a lump sum or it doesn't. Critical illness cover, so a lump sum on diagnosis of things like cancer, stroke, attack, etc. Income protection is the third, so an income replacement if you're unable to work through sickness or ill health, and private medical insurance. So there's lots of advisors on the personal side that deal with just all of those four or just a few of them. The next tier up is where we specialize. So the first is shareholder protection. We look at the shareholder agreement and we check what it says about a deemed transfer of shares. Now, there are some that don't mention it at all, but if a shareholder dies, what is the plan for that business to buy the shares back? Or are they happy to be in business with that person's husband or wife? Or child if they're not with anyone. What does that look like? So that's really when I said about the succession planning. It's making sure that the business has taken legal advice and thought about what it looks like if the worst were to happen. And that could just be life insurance in that wrapper, but it could also be critical illness cover, depending on what the clauses in the shareholder agreement say. So without going super granular on it, it's all about making sure that the business owner has really considered, if we have a really bad day and someone's died or become very, very ill and they're never going to return to work, what are we going to do about buying those shares back? In the first year or two, it usually doesn't make much difference if it's a company that's following the usual trajectory of, not making much money or making a loss and then making relatively small profits. But when it's worth hundreds of thousands, millions, tens of millions, etc., you've got a mounting problem. Now, you've got a mounting ability to deal with that problem because you've got more income the more you're worth. But it's usually, it's always one or several steps ahead, and it's not possible to be able to just go, okay, we'll just dig in the back of the sofa and find £5 million to buy the shares back. So that's number one. The second thing I mentioned was continuity planning. So there's a few that wrap up into that. There's key person cover, which essentially is some money if a business owner or another key member of staff that's employed, doing some part of the day to day, either dies or becomes ill or can't work for a long period of time. And all three of the first that I said, life, critical illness, and income protection, could be wrapped up. It could be one of them, two of them, all three. And the objective there is just to have a cash injection into the business after one of those events. Now, I know it sounds like it's basically exactly the same as what shareholder protection does.
Yeah.
But it's written differently. Shareholder protection is about buying shares back. Key person protection is all about making sure the business can continue to survive after the loss of a key person. It might be, managing director's got lots and lots of uh, contacts in the industry that just can't be replicated, or it could be a financial director and they would need immediately to go out and hire someone else or outsource it to their accountant or whatever. The third is, still part of the continuity planning is debt protection. So a lot of our clients have taken out commercial mortgages, or they've got invoice factoring or some other financial arrangement that if the worst were to happen, they would need to make sure that was paid back, because the business might not be profitable enough to maintain those payments. And they might have also signed a personal guarantee on it, which they're usually not happy about signing, but usually want the debts. If they're concerned about personal guarantees, you can insure part of it. And then pivoting more to the people within the business and their needs as opposed to the business's needs directly, you've got individual cover and you've got group cover for the life, critical illness, income protection, and private medical. So we do schemes on the group side from 2 people up. It's not like common to have a really small group scheme, but if you've got a business where, there's only a few of them at the moment, but they've got very aggressive growth plans, it might be appropriate to do so, because instead of having to write another plan every single time someone joins, you just add them to the group. And it's very cost effective, especially at scale. And then on the tax saving side, which is still, part of the employee benefit, so to speak, there's 2 that are incredibly beneficial. The first is relevant life. So a relevant life plan acts a bit like an ISA. It's just a tax wrapper for a life insurance policy that a limited company will own and pay for. It's an allowable expense. You save on corporation tax. It never gets to the point of paying income tax or NI. And the proceeds pay into trust for whoever you want the money to be left to. So if you've got a limited company and you've got a requirement for term life insurance, it is usually, I can't think of any reasons why it wouldn't be, it's usually the best way of setting it up, especially when you consider that you can convert that into a personal plan down the line. So if you sell the business or you leave it for some other reason, you can just convert it into a personal plan, which is then priced as of when you took it out, not as of now, when you're older and maybe less healthy and things like that. And on the flip side, income protection, which is one of the more undersold products, but is incredibly valuable to anyone who's not, a multi-millionaire who's got assets that are, earning them their keep. If you are reliant on your own income, and usually that's from a business, the clients that we're talking about specifically, you can put what's known as an executive income protection plan, and it is also typically considered an allowable expense for the business. So it's effectively a sick pay policy for that business, covers up to 80% of salary, dividends, other recurring income, and then on top you can do NI and pension. So, if you've got, someone like you who's advising, okay, you've hit that threshold, you're about to go into the additional rate band, and maybe you're saying, look, we're going to set up a company pension, you're going to put in a couple of grand a month or whatever it is, so that they're making the most of that tax efficiency, executive income protection is an absolute no-brainer because you can protect the income they're drawing and the income that they're putting into the pension. So if they go off long-term sick, those pension contributions don't stop. They're continually building and building and building, and whatever their retirement goal that you've worked with them to set up is set up so that it can still be met rather than the contributions stopping because they can't work.
Yeah, and that feeds in exactly why we have this relationship and why we feel this is so important, because we, from the day one, we'll set out someone's future plans, but anything can happen along the way. And if those things happen, the idea of the services that you offer and the insurances you provide clients is to make sure that the protection is there so they can either still achieve their goals or their family can. That's the outcome of what you're effectively trying to do. So, but there's obviously some key tax benefits, I believe, to certain things. Is that mainly with the relevant life insurance you just spoke about in terms of having, is there any other tax benefits?
Relevant life and executive income protection are the two key ones that qualify as an allowable expense. There are a few others that you get some benefits in kind, and there's some that are kind of tax neutral. It's really important to consider what the tax position is of these products, but it isn't the main concern. The most important thing is there's a risk to the client, and we're helping plug whatever that gap is. The second bit is really how is it best structured for that particular individual. On executive income protection, for example, that isn't convertible. So we'll do a term that matches what their expected exit is. But if that person's looking to sell their business in a couple of years and then is going to go employed somewhere else, if they've sold it for enough money, they probably won't, but maybe they do. Then a personal policy might be more appropriate because actually, they can keep that long term if they go into an employed role.
Yeah.
Whereas, if they've taken out a short one, had to cancel it, had some medical complications, can't get the product anymore, maybe they're too old or, medical history's changed, then that might not be the right advice, even though it's the most tax efficient way of doing it.
Yeah, and like a real life scenario there, which we see a lot, is consultants or people that are kind of working for a limited company for their tax purposes. Perhaps won't do that forever. They might go into an employed role in a few years' time, and you don't really want to be in a position where your insurance ends. And like you say, anything could happen in the meantime. You need a new policy. So
And
that's
one of the things on that, so I'm just sorry to cut across, is if you are a consultant, your income might fluctuate because you might end up doing a different contract or whatever it is. Active income protection is not always the best solution for them because you can't, with most of the products, you're medically underwritten at the point of application, and then they might ask for a GP report and stuff like that. On income protection, there's two phases to the underwriting. There's the medical underwriting at point of application. There's the financial underwriting, which at certain sums assured will be done earlier on, but is usually done at claim. So if you've got a situation where you're on 100 grand and you've covered yourself for the maximum, let's say it's a personal policy, 60 grand, and then you've gone part time and now you're only on 50, you've paid for that 60 grand's worth of cover, you're actually only going to get 60% of what you can prove. So you'll only get 30 grand a year of benefit, even though you've paid for more. You can't be better off sick financially, obviously, than you would have been otherwise. So there are a few options. There's 3 or 4 providers that allow a financial underwrite actually at the point of application. So you send in pay slips or SA302s and things like that, and then they pre-verify you. So there's no further requirement for that later on. And that can be worth more than the tax efficiencies if someone's income is going to fluctuate, or potentially fluctuate.
yeah. So I'm intrigued to understand your process. So you go into meet a director of a business or an owner, and they've got no idea your services. You don't know their situation. They don't know if they need anything that you don't know yet. What do you do? Where does it start, and kind of how do you uncover what protection might be needed? Because you've listed a lot of things there that someone might need. Sometimes they might need any, might not.
Yeah, absolutely. And I've had several meetings where we have a conversation with someone and say, look, actually, you've just told me all of these things, and you basically don't need anything because you're either you've got them set up correct already, or you've structured your businesses in a way that you're self-insured. So I don't imagine it's a million miles different from what you do. The initial meeting is a fact find, really, asking lots of pertinent questions, understanding what the risks are, what their hopes and dreams are, where the pain points might be, and being comfortable enough to push where sometimes you get an answer where you think, oh, okay, that person's not really giving me it's a bit of a fluffy answer, and you think, well, I'm not sure that that's genuinely the answer, and you push a little bit further and you find out that actually that risk did exist. And a lot of education, because there are people in your sector are the only ones really, apart from people in mine, that do this. There's a lot of mortgage brokers and personal protection advisors, and they don't really have the time for it because there's a lot of volume in that. type of role. And then, accountants may talk about it, but there's not, they don't advise on it, and so on and so forth. So, because of that, it's hugely under served, and people don't know about it. They might have heard of key person or key man, or a bit more PC now, but the vast majority of these products, there's usually something that the client's not aware of. So it's educating them. Once you've found out what the risks are, it's explaining it very clearly in jargon-free language, so that you can just get to the client can just get to a baseline understanding of what we're talking about. We go away, get an initial recommendation back, and then we'll do a full medical underwrite. So we need to get full medical history, go out to the market, find out what their all of the insurers will say as expected outcome, and then we'll look at the final recommendation, which obviously has to factor in things like budget as well as all of the different risks, and we just help them triage in the ones that are most relevant, and if there's some that aren't, we'll get rid of them, or reduce the amount of cover to fit budget.
So you found you got into a business owner, you found potentially that there's a risk there and they're not protected against it. Where do you then decide on the level of cover? I mean, obviously, I appreciate this will potentially depend on what type of insurance they might need, but where does that process begin?
Yeah, cool. Well, it's within the fact find, really, because you've got to be aware of where that business is and what the makeup of it looks like. Are we going to be recommending shareholder protection 6 months into a new company? Not really, but we might need to do key person cover. We're doing one at the moment where there's a VC fund that's been, so if we understand where in the business cycle they are, certain products will be more appropriate. So going back to that VC example, that fund is putting in some money into this business. It's an AI startup, and the three people who are working in the business are hugely important to it. They're all developers or geniuses. I don't know what they do, but it's really, really techy. And if any one of them passed away or got very sick, there's a potential that money just evaporates, because they've
Yeah,
spent it on
yeah.
developing this tech that then doesn't get built. So a lot of investors and banks will say you must have key person cover in as part of the condition of the loan. That's not always the case. So just going back more macro, if we understand where in that journey the client is, we can understand what is most appropriate to them at any one time. If they've got to the point where there's 1,000 people, you may not need key person cover, because there's hopefully someone that's near you in terms of the org chart that you can just sort of slide in, and the business isn't going to go under. But in the SME space, you could lose the managing director and you could be out of business in a month, maybe even a lot sooner. So in terms of levels of cover, I won't list off all of them, because I'll bore you to death. You'll fall asleep and you'll be on camera snoozing. But things like Shareholder, for example, we will operate on the basis that if we can get an accountant's valuation from the client's accountant, then we will use that, because they'll have a really in-depth understanding of what the business does and any growth and things like that. We might not have anything like that, and they might not want to pay for it. So we might need to use what the financial underwriting will require of us when we put the applications in, which is fairly basic. It's looking at the average of the last 3 years net profit, and applying a profits to earning ratio, and adding some net assets back in. So that's our backstop. But then we also ask about what you're realistically going to do in terms of expansion and exit plans, and what we don't want to do is, if someone tells us they're going to sell the business in 5 years, we're not going to put a policy in place for 25 years, because the premium is going to go through the roof and they're never going to keep it for that long. So you're just artificially pumping up the cost for the client for no real good reason. You might add a couple of years on, you might do a 7 or 8 year term, because they might not meet that particular goal of deadlock in 5 years. But that's a conversation with the client. And there's different ways of looking at it. So key person cover, you're looking at, is that person responsible for bringing in a certain share of gross profit? Are they someone that's sort of more function driven? So like an FD, where you could potentially just say, look, we're going to hire for that job and it's going to be 120 grand or whatever. And also the time frame that it would take to get that person back in the business. It could be that they've already thought about it and the plans are in place, and we're going to hire this person. If they're not available, we've got 3 backups or whatever. That's rare. Most of the time it's, I've not really thought about that, because I've been so singularly focused on driving my business forward. I didn't really stop to think about what's coming from behind or to the side. So it's really valuable having these conversations with clients, because then they go, right, okay, yeah, no, we should probably think about that. The stuff that we do doesn't solve the problem from it helps, it alleviates the financial pressure, but it doesn't completely solved the problem. You've still got someone who just died or become very ill, and you need to solve that problem. It just means that now you've got a load of money in the bank that can keep the wolf from the doors for a period of time.
Sure. Yeah. And in your everyday role, do you find that there are many misconceptions?
It depends how. So we get a lot of our referrals from introducers. So it honestly depends on how in depth the conversation's been before it lands with us.
Gotcha.
So I remember this conversation. It was an accountant down the road from us who we'd done their cover for before. He'd had a conversation with one of his clients. This guy phoned me up and he went, "You did so and so's cover. I've got to have what he has." I was like, well, "You're not an accountant. You don't run a big business. You're a contractor. We'll look at it for
Very
sure.
different situation. Yeah.
But you probably don't need what he needs. You probably need a bit of that and maybe something else." And that was a fait accompli because he was so sold by this introducer that it was an obvious thing that we helped him, and it was a really good client. On the other side, if the conversation's been a bit wishy-washy and not particularly in depth, because it's business protection, they often will think more GI lines, so general insurance, so things like professional indemnity, employer's liability, cyber, stuff like that. And if they're sort of thinking that, we just will, very early make a distinction that that's, very much a different type of insurance that is potentially required by law. Definitely something that you should consider. It's really important. But we're looking at more of the business risks that not as many advisors will talk to them about. And when they understand what the benefits of those things are, it's fine. It's just that I'd say that's the biggest misconception. In terms of the actual products that we advise on, because we are educating clients often from scratch or from a relatively low baseline understanding, there isn't too many misconceptions because the language patterns and the conversations we have are designed to sort of head them off at the pass so they don't misconstrue, because critical illness cover and income protection, right? How do they differ? They're both ill, you get some money, but it's how they pay out, what they pay out on, why you might want one over the other, the tax efficiencies of it. And we will have explained all of that before we get to that point. So there are some, usually, there were sometimes, but more often than not, we've sort of headed them off.
Yeah. And I can imagine the slight issue is the fact that the people referring, you're obviously a lot more knowledgeable in the different areas, the types of insurance and where that fits into an individual in their business. Whereas I can imagine a lot of the time you'll get a referral for what the person referring it to might be thinking it's for someone who needs X, and it's you go in there and actually they don't need that at all and they need a different type of insurance. I mean, you probably had clients from me like that I've suggested they need this and then you've
No, you know
suggested
loads,
actually
mate.
they don't.
Yours are always exactly what you say. But yeah, sometimes that does happen. But we take enough time to help those clients really understand what it is that they're buying because the cost ranges massively. The cheapest product I've ever done was £5 a month. The biggest one that we're looking to quote for at the moment might be 90 grand a month. So there's a humongous variation, and unless you're actually having a really deep conversation, some of these things cost a lot of money, right? So is it right for you? Does that then lead to opportunity cost elsewhere? Because if you could use that money for something to grow your business and then maybe not have those risks, maybe that's a better use of the money. So it's just making sure that they understand what they're buying, because I wouldn't want someone to take something out and then cancel it years down the line because they're not going to get that money back. They're not going to get the premiums back. It's a sunk cost every month, and therefore it's got to be right, because if they cancel it, they're just out of pocket.
Yeah. So if you're looking at a business and maybe insurances they already have, or perhaps don't, what would you say are the most common mistakes you've seen?
Common mistakes. Not a long enough term. There's some really boring tax rules about what business protection and it being a suitable length, and some people interpret that it can't be longer than 5 years in term. Um, I'd sort of I'm a bit dubious when I hear that, and I think sometimes that people do a short term so that they can rebroke it. If I'm perfectly honest, as advisors, there's some out there that do it. If you've only got a 5 year term, it could be that at the time that was taken out, that actually was the right thing. But I've seen people taking out life insurance that's really to deal with a mortgage, and it's only a 10 year term, and their mortgage is 30 years, right? How have you got such a huge, maybe a couple of months because the term didn't perfectly marry up, okay? But a very different term. That's something I've seen. We did. There was an IT recruitment business in London that we helped. They had key person cover on quite a few individuals. One of whom was the widow of the owner. He had passed away, left her the shares. She didn't do anything in the business on a day to day. She owned the business. That's fine. She needed some other advice, but another advisor had given her key person cover. There's no key person risk. If she died or became ill, it would be very sad,
Yeah.
but the
I think
business would be fine.
that's quite a relevant thing though, because if I look at what we do and I look at every aspect of financial planning. So someone's retirement, we always talk heavily about reviewing their plans as life goes on because things will change. Someone who's got a will, the amount of times I sit down with a client, have you got a will? I ask in every meeting. Yes, but I did it 30 years ago. I've had 3 kids since then, blah, blah, blah. I guess it's the same for yourself, right? Because if someone's set up key person insurance, 10 years ago when they're at the early stage of their business, they're focusing on growth, and then 10 years down the line, like that example you said before, right, that might not be needed anymore. It might be that they need some shareholder protection or whatever it might be. So would you say that's quite a key part of what you do, is making sure that things are up to date as time goes on?
Yeah, absolutely. So we try and review our clients every year. It's not necessary every year, obviously, because if nothing's changed, then it was still fit for purpose. But sometimes we'll pick up, yeah, no, so and so's left, and we've got a key person policy. Okay, well, we just need to
Yeah.
cancel it. It's costing you money for no real reason, right? There's other instances where they might have had children, and you need some child critical illness cover or something like that. But yeah, I mean, there's loads of instances where that's relevant. Shareholder protection, valuation of a company. We do most of ours on an RPI index basis, so that it will increase because a lot of the businesses that are going down in value, we're not typically insuring because they haven't got the money, right? But the ones that are going up in value, they might be worth 1 million today. They might be worth 5 million in a couple of years' time. Even if we've indexed it and it's gone up incrementally each year, they might have 1.2 million pounds worth of insurance at a push. They're not going to have 5 million pounds worth of
Mm.
insurance. So if they then die, and there's a requirement in the shareholder agreement to say, well, that person's died over 50%, you need to buy me out for 2.5 million. You've only got 500, 600 grand. Yeah, that's a nice little initial pot, but the rest
Sure.
has to come out of profit. So does that then kill the business? Because if you're spending 2 million of profit over, even if it's a long period of time, 5, 10 years, it's still a lot of money that without that person, it might go under. So you spent all that time building the business and your family doesn't get fair value out for what you've done. So absolutely reviewing it all the time, not frequently, is
Yeah.
really important. And the other thing is sometimes, if they had an exclusion, right? So an income protection policy, they had some mental health issues when they took it out. And that's one of the two biggest claims, musculoskeletal mental health issues. And that was a long time ago. When we rebroke it, we might be able to get rid of that exclusion because it falls outside of the question set time frame now. That's a win, right? They might pay a bit more for sure, but it could be that's really good. We're doing one for a client at the moment that came from a financial advisor. He's got an income protection policy that's age banded. Now at the time it was super cheap because he took it out when he was probably late 30s, early 40s. Now he's 50 something. It's gone up a lot. From the time that I first spoke to him, it was sub 100. It's now over 200. So we're rebroking it to a guaranteed premium, and he won't have an exclusion. It's all fine. So now he's going to save 80 quid a month or whatever it is on his income protection. And if he just left it, it would have just mounted and mounted and mounted, and probably got to a point where he just went, I can't afford this anymore, and cancelled it. And then all of that money was a sunk cost, and he's had no benefit from it. And you know, realistically, you kind of want it to be a sunk cost, and you never get a benefit from it because you don't want to become ill or die early.
Mm.
But if you do, you want the product to pay out, right? So yeah, regular reviews from all of those different angles are really important. And also just as a refresh, sometimes we've had clients that think, we had a lady in 2 years ago, I think she was. She was like, I don't need to review it initially. This was the mum of an accountant that we speak to. And she was like, no, I've got a life and critical illness policy that covers my mortgage. Mortgage is 200 grand. Policy was on a decreasing basis at 90 grand 23 and a half years ago. So it had an 18-month window to run. And by that time, it was worth less than 10 grand. So she's got this risk that she thinks she solved because she did it before, never been reviewed. So we needed to look into it to make sure it was fit for purpose then. So
Yeah.
lots of different things.
I think that's quite like we see a lot of complacency with perhaps different things, but I can imagine in your industry, you'll probably see that a lot with people perhaps saying, I've ticked a box, I've got some insurance, I'm sorted, I've got insurance. But another thing as well is inflation, because if someone took out a policy 5, 10 years ago, just as a like a life, simple sort of life insurance policy. I see it a lot. I see someone who's got 200 grand worth of cover, for example, that they took out 10 years ago. Back then, 200 grand, we've had sort of 7% inflation for quite a few years now. That 200 grand isn't worth much in today's money compared to what it was 10 years ago. So it's just summarizing it, reviewing it, keep reviewing it as often as it makes sense to do so, because situations will change. There's lots of factors there.
Actually, Tom, just to pick up on that, I think indexation is really, really important. Our default is to talk about indexation on almost all products. So if they don't need it, that's fine. We won't do it. But the only one that you definitely don't do is on a decreasing policy, because obviously you can't index
Yeah.
something to go the other way. If that's related to a mortgage and they want it to decrease because the cheapest way of doing it is totally fine. But you're absolutely right. If you do a critical illness policy and you're doing it for a multiple of income rather than for the whole mortgage, which is more often than not what you do, because the mortgage is usually through the roof and it's just too expensive. If that person's insured for 50 or 100 grand and you don't index it, it's only going to buy them a relatively small amount of stuff. So their morbidity risk is going through the roof. As they get older, it exponentially increases and to a point, and then it dips. But then their amount of money is going the other way in real terms. So you've got this relatively small gap, and then the delta gets bigger and bigger. Income protection, that's really important, because it compliance with the compliance hat on. You might say, well, hold on, that person's paying 1,500 quid on the mortgage, other 800 on bills, and then we're going to cover them for 2,300. Well, that's great. That's on today's money. So if they've done that in 2019 and then fast forward to that today, that might be 3.5 grand. I'm making those figures up, but it could be in that realm, right? So then you've got protection that was put in place to achieve an objective that is now no longer doing. So you'd need to review it, or if it was done correctly in the first place, that 2,300 might be closer to three and a bit now because of the inflation link that we would have done. And there's also the different ways that the policies, actually work with indexations. The premium increases at a quicker rate than the sum assured, and it's different for all the insurers. So some of them are much better. Royal London specifically, they're one of the better ones. They only do 1.2 times as a multiple instead of 1.5 for many of the others. So even if the premiums are about the same to start with, other insurers, the premiums are going to go much quicker, grow much quicker than say a Royal London. And there's loads of other factors.
So let's briefly touch on shareholder protection. What would you say makes a very strong agreement?
Well, I'm going to caveat the comment by saying I'm not a lawyer or a solicitor in any way. I've never done a day of any law courses. So I'm just purely talking about from what I've seen. I don't go through the whole document, because things like drag along clauses and remuneration, it's not particularly relevant to any of the conversations that I'm having. There's one section that I look for, and it is the deemed transfer of shares. So it first and foremost, having that as a section is really important. Second part is saying, okay, what's the wording around that? Because a lot of them, it's just debt. Obviously, you can't take the shares with you. Fair enough. So debt's really an important one. But then the second, which we see sometimes but always, is something along the lines of, if you've had a critical illness to the extent that a reasonable insurance policy will have paid out, then the deemed transfer of shares will have happened. So to unpack that, what you need to have a conversation between all the shareholders, because what you don't want is, let's say that the two of us run a business and it's worth a couple of million quid, and we're 50-50. I have a heart attack and I'm all right in 2 months. But because of the wording in that shareholder agreement, it's any critical illness, for example. I don't never say that, but let's say it was like super, you've now got a payout of £1 million, and you've got a legal agreement that can then be used to buy me out. I can't refuse. So you might not want to do that because we're friends and we're, in business together, and you're just happy that we're back in business. But if you knew that we were just about to take on a contract that was going to mean that the business was going to be worth £10 million, you could use that legally to get me out. I've got 1 million. Now, million's a lot of money. That's great. But I could have had 5 in a few years' time. So you could use that as a way to get me out. And so having wording that's very, very clear, and about valuation, because, some of the best wording that I've seen, I can't remember the exact terms, but it's about, how you actually get to a valuation at the point of the deemed transfer. And it's based on, an independent chartered accountant, not someone, you mate down the pub who's going to lowball you or highball you so that you can swing it one way or the other. Having it, not using an off the shelf online one, which may do the job, but, might come back to sting you. Having a solicitor that you can go back to, and if there's if they've made a mistake, you've got recourse, right? You can go to them. You did this bit of work. This is I'm not the expert. Yeah, that's what I would say on that point.
Yeah. It's quite a common thing in finance that people will sometimes leave things till another day, next week, next year. I've still got ages to. I need to sort this out. What would you say the urgency is for people to look into it and just have a review of their
It's
situation now?
a really good question. What we do is maybe not so much on your side, but definitely on what I do is really important, but not particularly urgent before the event. That flips immediately as soon as someone has a diagnosis to I needed to do this yesterday, and you can't go back. In all likelihood, we're in our 30s. Are we that likely to get cancer at the moment? Not that likely. Are we likely to die? No, not that likely. I don't know what the statistics are, but as you get older, obviously these things increase in probability. We have had people who we've been referred that we've tried to get in touch with, and then an event has happened. So we're currently helping a client at the moment who's got terminal cancer. I think he's 42. I'm not dealing with it. It's my business partner's dealing with it, so that's why I don't know that age. But he's had some really horrible stuff go on, like bowel removed, young family. So we're helping him with that claim. Not a good story because he's only 42, but it's good in terms of the financial outcome because we're getting the payment from the policies. On the flip side, I had a guy that I tried to get in touch with quite a lot, just Naz, and I'm 37 or whatever it was. I'm not interested. At 38, he had a stroke. He was okay enough to talk a few months later, and he phoned me up and was like, "Look, I think I didn't do this stuff. I just want to check." Da, da, da. And he wanted to know if he could get critical illness cover at that point because he was worried he had to go back and have a stent put in. 50% chance he was going to die on the table, according to him. So the best case that I could find, I did some research because he's in a bad position. I didn't want to just go, no, it's too late. See you later. The best scenario that I could find was a year after successful surgery, they would potentially cover him, and they were going to add £5 per £1,000 of cover to his premium. So it gets, at that point, it's super expensive for what he wanted. And, another scenario, one of the mortgage brokers that I work with referred a barber to me. This guy's, a premium barber. He's making his shop 10 grand a month and he's got 2 or 3 other chairs, but he's the biggest earner. If he doesn't make that money, the lights don't stay on for very long. And, I contacted him loads of times, email, text, phone, da da da. Yeah, I probably should do. I had a chat with him and his partner, and then got a recommendation ready, ghosted me. Just like, I can't do it. Stopped answering. And eventually, like anything, you just got to go, well, I can't, I'm not going to waste my time. He fell down the stairs and broke his back. He's mid-30s. He's had to return to work after, I don't know how bad the break was because I haven't spoken to him, but he had to go back to work after about 2 months just to support the business. If it had executable personal income protection, his income would be covered. And if it had some form of key person cover, predominantly the income protection version of it, he could have had 75% of his gross profit figure. So let's just say it was the 10 grand. He'd get 7.5 grand into that business every month. That would definitely cover rent, rates, utilities, and things like that. And he wouldn't have to force himself back because I don't know what the prognosis looks like for his back. Hopefully he heals and he's okay. But it could be that returning to work and standing for a few hours every day cutting hair actually causes him more long-term damage that he can never recover from. And if he just paid a bit of money on the policy, he wouldn't have had to force himself, right? So
Yeah.
it's so important to have these conversations before the event because you either can't pay for it or you have to have a much reduced amount of cover because it's so expensive, or potentially you're uninsurable.
Yeah.
And I've had clients coming to me, well, there must be someone who's done it, and you're like, well, yeah, but you've had X, Y, Z, A, B.
I think sometimes, from what I've seen, often it can just mean people can end up with an exclusion on their policy for something that they would have been included for if they had the insurance prior. It wouldn't necessarily have paid out, but just let's say it's something less. Some of those examples there were quite serious examples of health issues. But let's say something more minor, a scare of some sort, but it didn't materialize in something, then the insurer will see that on the medical history and could then put an exclusion, for example, on that particular thing, or family history if parents and things have issues. So the sooner, something I've always spoke to clients about, the sooner you take insurance out, the more the more you're going to be covered for, and also the cheaper the policy because you've got less that they're worried about, and the age, you're younger. So
I said earlier, Tom, that £5 a month. So it's a woman that does some GI broking with parts of business, or have done in the past anyway. And she said, "Look, I want to get my daughter some cover early on because she's young now and she's healthy. So she's 18. We got her 170,000 of life insurance for 40 years." For £5 a month, that was the minimum premium. She got 24/7 GP. So this is another thing that didn't come up in the conversation. Loads of them have value added services. So you go on the tube and you're like, would you pay 35 quid to see a private doctor or whatever? And there's adverts for medical services. Okay, it's not in person, but you can get, as part and parcel with a lot of these providers, 24/7 GP access on an app on your phone. So I've used mine before when I couldn't get a doctor's appointment, or it was the weekend or whatever, and I get seen within a few hours. They email me a prescription. I can take that to the pharmacist, and then I get my medication. So I've only used it once or twice, but having that in the back pocket is really useful, and you can use it for your household. So you can use it for your partner, you can use it for your kids. And this girl's going to only pay £5 a month for 40 years. Yeah, she might have a mortgage that runs for a bit longer because she might not have taken one out yet, but she only needs to do a top up because that's going to run for till she's 58. Might have a mortgage that's a bit more than that. Fine, just do a small top up, and then the top up's priced as of her age at the time she takes it out, not the whole thing. So yeah, it's so important to just not stick your head in the sand. And I think with business owners, especially the ones who've been in part of that journey for a long time, they've set the business up, they really understand how hard it was just to get out of the ground and get to where they are, that they're a bit less emotionally attached to spending that 20 quid or that 100 quid or whatever the premium is. When it comes out of your personal account, you're like, oh, I don't want to spend that. I would rather go to the pub. The business owners, most of the time, are a bit more like, yeah, okay, we can't get away from these risks. We understand that we've got them, and we need to address them at some level. And then, yeah, it's much easier to have that conversation.
for our clients listening that might be relating to some of the things we're talking about here, maybe we could just give a couple more examples of certain insurances that you offer. It's a bit across the different range of businesses, like a real life example of clients that you've helped, and then might allow people to be a little bit more relating to the things
Yeah,
we're.
of course. So I'll give you three. I'll give you an individual, an SME, and then a much bigger SME, more the medium size. So uh, a guy that came to us had some protection in the past. He was an IT contractor. So this scenario, he was buying with his wife. She was a lot older than him, about 15, 20 years older, something like that. And she didn't work. He earned enough money to support the two of them. Fine. Whoever had set it up before, they were on a joint life insurance policy, but because he was, let's say, 40 and she was 60, the premium was like 45 a month for the mortgage amount cover. When we looked at it, we could do a relevant life plan for him for about 10. That was pre-tax adjusted, so it worked out to be like 7 or 8. And she didn't really need the life cover because whilst he'd be really sad, they didn't have any kids, and if she died, it wouldn't affect anything to do with the mortgage. So the risk wasn't there. We could then use that budget for some critical illness cover, which he did. He either had critical illness cover or income protection, one of the two, but he didn't have both. But with the budget that we created from that, we could then help him get whichever one he didn't already have. And then we did the income protection through the business as an executive version as well. So that's that one. So that, it doesn't have to be huge money that they're paying, for us to deal with. We don't turn clients away because, the premium's not big enough or anything like that. We're not in that business. The next size, one of our bigger ones, it was a client who'd gone to a solicitor to get a shareholder agreement done. It did mention death and it did mention critical illnesses. And when we looked at it, they're basically a branding marketing agency in London, about 20 staff, 2 shareholders, and on the shareholder side, we needed to protect the value of their business, which was about 3.5. Then went through we're actually dealing with the financial director. So when we had a conversation with her, it was much more, well, actually me and this other person, as well as those two are key people. We don't have any employee benefits. So we ended up doing relevant life, key person, and executive income protection for the 4 of them, as well as the shareholder. And then on the really big side, we deal with some companies that have got hundreds of staff and thousands of staff. Some of that stuff that I've just talked about, those other clients, not as relevant anymore. But the things that are relevant are employee benefits because they've got to a size where they want to retain the right people and they haven't yet set up things like private medical insurance, death in service, and so on and so forth. So those, depending on the size and the journey, that part of the journey that they're on, will in large part determine what products are most appropriate to.
Perfect.
Sorry, Tom, there is one other thing which you may do, so I don't want to step on your toes, but obviously you might do some inheritance tax planning for
Yeah,
clients.
yeah, absolutely. Yeah.
Things like, even if you're doing it and not us, whole of life gifting Vivos for any clients who are wealthy, especially with the changes that are coming in next year, you must have that conversation with someone who can give you tax advice. We can't do it. We just do the insurance on it. You might do the insurance yourself on that particular side. It's not really business protection, but it's something that is crucial to anyone listening. If you've got an inheritance tax problem, first and foremost, speak to someone who can help you mitigate those things. And for what you can't mitigate, there is insurance as a backstop.
Sure. Yeah, and that is kind of what we talk about day to day with clients, especially as you say, a lot of changes coming in with pensions becoming part of someone's estate in 2027. So I think whole of life insurances are going to be quite a big part of the inheritance tax planning. I mean, they already are, but I think there's going to be a
There's going
bigger
to be a
mark.
boost, isn't there? And the RISAF planning that goes along with them is really important. So yeah, it's really a key consideration.
Yeah. Right. So thank you very much, Nathaniel. That was hugely insightful. Nathaniel, thank you very much for your time today. That was hugely insightful. So really for clients, if you're not sure where to begin, Very Wealth and Business Protected offer a free initial advice, initial meeting to understand what you might need, if you need anything, kind of as we've covered, whether there's any shortfalls in any areas. For more information, if you want to send Nathaniel an email, his email address is nathaniel@businessprotected.co.uk. And then us, Headway Wealth, is inquiries@headwaywealth.com. Nathaniel, thank you again for your time today. It was really useful. I hope you all enjoyed the session.
Yeah, cheers, Tom.
Thank you.
Pleasure talking to you.
Take care.